We are doing the third part of our video, and then today we are solving 2024 October November paper 12, and this is question 21 to 30, third part. So without further ado, let's get started. 21, it says a company returns on capital employed decreased to 10% in the current year from 15% in the previous year. So return on capital employed, which is decreased from 15% to 10%. The director have noted the following changes during the current year. So in order to answer this, first we need to know what is return on capital employed. So return on capital employed basically comprises of profit from the operation divided by capital employed, which is there in the formula here. If you remember this one, return on capital employed is profit from operation divided by capital employed into 100. So what is the reason for it to decrease? Okay, so either the profit should decrease, or the profit from operations should decrease, or capital employed should increase and the profit remains same. So in that case, the return from capital, return on capital employed would decrease. So the very option that they have given is a substantial investment on non-current assets were funded by new debentures. Okay, so debenture was a part of capital employed. So we are investing in non-current asset and it is funded by collecting the new debentures. That means there are more capital employed in the business, because if you see capital employed, which is issued share plus reserve plus non-current liability, and debenture is non-current liability out here. Okay, so this could be one reason we have. Second one is there was an increase in current liability. Current liability does not include or does not affect either the profit, or it does not include in the capital employed as well. So this is not the option. Number three, the expenses to revenue ratio increases. So expenses to revenue ratio increases means expenses divided by revenue. So that is the formula that we have. Where is it here? Oh, out here. So expenses divided by revenue, it is increasing. So that means there is more expense or there is less revenue. And in both the cases, if the expense is more, then the profit would decrease. And if the revenue is less, profit would decrease in that case as well. Okay, that means it will also affect the return on capital employed. So if you see here, profit from operation, which would decrease because there is a expense ratio increasing. Okay, and that you can see from this. So here we calculated profit or loss using the profit and loss statement. So if your expense increases, your profit from operation decreases. If your revenue decreases, then also your profit from operation decreases. Okay, so 3 is valid. Last one, the interest rate on the overdraft increases means we have to pay more interest. Okay, so more interest does increase the cost, ultimately decrease the profit. But remember that profit, if you look at here, it is the profit from operation we are including, and interest would be subtracted after profit from operation to find out profit for the year. Okay, so that means it would not affect the profit from operation at all. So it will also not affect your return on capital employed. So these are the two options that would influence your capital employed. One is number A, a substantial investment in non-current asset, and then number three, the expenses to revenue ratio increases. So your correct answer is B. Okay, let's go to the next question. A sole trader cost of sales is 240,000 and the gross profit margin is 20%. What are the sales for the year? Okay, this question is very straightforward. So the cost of sales is given, which is, if you look at the statement of profit and loss, so this is the amount of cost of sales, and they gave us the profit percentage. So profit percentage out here is margin. Margin means 20% calculated on the sales. Okay, but we have here is the cost of sales. So what we need to do is we need to convert the margin into markup. We'll simply write 20 divided by 100 minus 20. Okay, so 240,000, and if I calculate 20% of that, this is markup. But we are not doing that, we are using margin. So to convert the margin into markup, what we do is 100 minus 20. Okay, so 100 minus 20 is 80, and that will give you 60,000. So the profit included out here is 60,000. Okay, so what is the question is what are the sales for the year? So cost of sales plus profit will make sales, so the correct answer is C. A business employs a machinist to make a single type of product. As demand increase, more machinists are employed. Every time eight extra machinists are employed, one extra supervisor is needed. Which option best describes the total labor cost? For machinist, because they are used to make the product, so they are the variable cost. Okay, because the more machine or more product we want to produce, the more machinist we required. And the cost that we use for the supervisor is a step cost, because it will remain same for some time and then it increases. Like I need to pay supervisor a salary, and let's say we are paying $1,000 to a supervisor. So even if he supervise one machinist or eight machinists, I will still pay him $1,000. But as soon as the ninth machinist comes in, I need to hire another supervisor, and my cost would increase from 1,000 to 2,000 because I need to hire another supervisor for another 1,000. Okay, so that is the cost, which is step cost. So the correct answer for 23 is D, machinist variable cost, supervisor step cost. Here it says the inventory movement of a business in 3 months period are shown: January, February, March. In January, 100 units receipts and the cost is $5. And then again we received another 200 unit, and this 200 unit at a cost of $6 per unit. Then in February we issue 50 units, and then in March we issued another 250 units. Okay, so the business used the first in first out method of inventory valuation. What was the value of inventory at the end of March? So we need to calculate what is the closing value of the inventory if you use first in first out method. So first in first out method is whatever I purchase first, I will use that first, and vice versa. Okay, so whatever I use later, I'll also issue that later. So in February, when I issue 50 units, first I use from this lot, okay, which is 100 unit out here. So if I use 100 unit from here, so 100 minus 50 units, now I have 50 units left from the first lot. Now in the month of March, I need 200 unit. So I also have 50 units from the first lot. So first I will use up this one. Okay. So first I'll use up this one. Now I'm left with 0 out here. So I don't have any inventory. Then I'll move into the second lot that I purchased in January. So I needed 200 unit, 50 I'll use it from the first lot that I purchased in January. Now the second I'll use it from here. So I need, out of 200, I still need 150. Okay, so I'm left with 50 units. So we need to find out what is the value of this 50 units which is left. Okay, so closing value of the inventory. And this 50 units was purchased at a price of 6. So 50 into 6, which is 300. Okay, so your correct option here is option D. For question number 24, answer is D. Okay. Okay, let's go to the next question. 25. A customer placed an order for 20,000 bricks. Which costing method will the supplier use to price the order? See, we are making number of bricks, and in this case 20,000 bricks. So this method is called batch costing, because I need to find out how much it cost me to make 20,000 bricks, and then add profit to that, and then charge it to my customer. Okay, so this is your batch costing. If you are just making one brick, then that would be a job costing. Okay, but we are making number of bricks out here, so that would be job cost, batch costing. So your correct answer is A. Okay, now 26. The following budgeted and actual information is available. Overhead, budgeted overhead, and then actual overhead. Labor hour, budgeted hour, actual hour, and the machine hour, budgeted hour, actual hour. What would be the company's most suitable overhead absorption rate? So we need to calculate OAR, overhead absorption rate. Now for this, we need, if you remember, we need to calculate overhead absorption rate, and for that we'll use either the labor hour or the machine hour, whichever is higher. So in this case, 28,750, which is labor hour is higher than the machine hour. So we'll use this one. Okay. We have budgeted overhead, and then it would be divided by labor hour to find out overhead absorption rate per labor hour. Okay. So 460,000 divided by 28,750. So 460,000, and it should be divided by 28,750. Okay, so let's do that here. Overhead absorption rate, total overhead divided by total labor hour. So it's coming 16. So this is per labor hour. So if I use 1 hour of labor, then I'm paying $16. Okay, as per my budget. 16, answer A, option A. The following information is available for the costing record. Budgeted overhead cost 32,000. Then budgeted direct labor hour is 4,000 hours. Actual overhead cost incurred is 34,000, and the actual direct labor hour worked is 3,900. Okay, in this question they are asking you, by how much are the overheads over absorbed or under absorbed? So we need to calculate overhead over absorptions or under absorption of overheads. Okay, so for that we need to calculate the OAR first, like the previous question. So OAR is calculated budgeted overhead divided by budgeted labor hour. So 32,000 divided by 4,000. So this is 32,000 and 4,000. So let's calculate OAR. 32,000 divided by 4,000, which will give you 8. Okay, so 8 is the over labor hour, OAR per labor hour. And then now we'll compare how much we are actually paying for this. So actually we paid is 34,000. Okay, and how much we should have paid, we should calculate that one as well. So we want to use 3,900 labor hour. So if we have used 3,900 labor hour at the rate of $8 per hour, then we should pay 31,200. Okay, so but how much we actually paid, the actual amount that was paid by us is 34,000. So we paid 34,000. Okay, so this is our budget. and this is the actual amount that we paid. Okay, so we were planning to spend only 31,200 for 39 31,200 for 3,900 hours, but we end up paying 34,000 for 3,900 hours. Okay, so let's find out the difference. So this is 2,800 is we have overpaid. Okay, so your budget is, here you can see 31,200 and your actual expense is 34,000. Okay, so you are under budget. So this is called under absorption. Okay, so under absorption of 2,800, and this is option C is the right answer. Okay, let's go to question 28. Which items are included in the calculation of contribution to sales ratio? Okay, so contribution to sales ratio formula, if you look at here, we do not include fixed cost. Okay, so this option A and B is not there, and we do not include the sales volume as well. Okay, so the all you have is option C, which includes variable cost and the sales revenue, contribution to sales. Okay, so option C, or variable cost minus sales, is the contribution divided by sales. The financial information for selling 6,000 units in August were as follows: selling price, variable cost, fixed cost, profit. The selling price was reduced by 10% in September. Which level of sales was needed in September to achieve the same total profit as August? Okay. Now we need to calculate what was the profit we are making in the month of August. Okay. So for that, we know that in the month of August we were selling 6,000 units and the profit per unit we are making was 6. So 6,000 into 6, that will give you 36,000. So we are making 36,000 profit. Okay, so that was the old profit we had. So the question is, if the selling price changed, and how many units will it takes to make the same profit? Okay, that was the question. So this is the formula for desired profit. So let's calculate that first. Okay, so here first let's calculate the selling price. If selling price decreased by 10%, so 10% of 40 is 4, so now the new selling price would be 36. Okay, and then we need to calculate contribution. Contribution is selling price minus variable cost. So selling price out here we just calculated 36, and the variable cost is given right here 22. So 36 minus 22, that will give you 14. So 14 is your contribution. Okay, and then let's calculate what was our fixed cost before. See, because now unit would change, because we will need to produce more units to reach this 36,000 profit, but the fixed cost would not change, because as per the name suggests, fixed cost remains fixed. Okay, so this is 12, which is per unit fixed cost, and we were making 6,000, so 6 times 12, which is 72,000. So this was our fixed cost before. Okay, now as I told you that in order to calculate the number of units, we need a formula of desired profit. Okay, so desired profit formula is exactly like break even point formula, but here only difference is in break even we don't have any profit, here we include profit. So fixed cost, which is 72,000, plus desired profit, which is 36,000 we want to make, and this would be divided by contribution per unit. Okay, in break even point we calculate fixed cost divided by contribution per unit. Now in desired profit we just add the desired profit out there to calculate how many units it takes to make this much profit. So 72 is the fixed cost, 36 is the desired profit, and the contribution we calculate was 14. Okay, I'll put this in formula. So 76 plus, so 72 plus 36, okay, which is 108, and this 108 would be divided by the contribution per unit. Again, as I can see that it takes 7714.28, so we'll say 7715 units. Okay, so to make this much of profit after selling price changes, this many units we have to make and sell. Okay, and 7715 units, that means option C is your right answer. Which statement correctly describes the cost volume profit analysis? Cost volume profit analysis is the relationship between the cost, the number of unit produced, and the profit that it generates. Okay, so basically it means that we are looking at how much it takes to make that product, what is the cost of making it, how many units we are making, and how much we are selling it for, so that we can earn certain profit. Okay, so the correct answer for this one would be first one. It says it assumes a linear relationship between the cost, revenue, and the volume. Yes, it will, because it will also look into the cost, how much it takes to earn the profit, and that is by looking at the revenue and how many units we have to sell. So it's a linear relationship between cost, revenue, and volume. And number two, it says that it can be used in what if analysis. Correct, because in cost volume profit analysis, if I change volume, let's say we are selling 1000 unit, we are making certain number of profit, okay, a certain amount of profit. Now if we change from 1000 unit to 2000 unit or 1500 unit, what will be the new profit for the business? So here we are using analysis of what if this changes, what if the cost changes, or what is the percentage of the profit changes. So we are looking all of that. So this will also be part of the cost volume profit analysis. So this is correct statement. Number three, it says it is a useful tool in long term decision making. So cost volume profit analysis is actually a tool for a short term decision making. Okay, so that means number three is not the right option, and it is not the correct statement for cost volume profit analysis. And last one, it shows how cost, revenue, and the profit changes in relations to sales volume. As I already mentioned before that cost, volume, and the profit are interlinked, so it would show that relationship. Okay, that if you change the number of sales or the volumes, then what will happen to your cost and how much profit that you earn. So number four is also the correct statement for cost volume profit analysis. So your right option is 1, 2 is wrong, 4. So 1, 2, 4, which is B. Okay. So this is your right option. Okay, I hope you understood all the question explanations. If you have any doubt, please write in the comment section and I'll try to get back to you as soon as possible. Okay, see you then. Have a nice day.